In times like these, it's crucial to talk straight about what's happening in the financial world. We're standing on shaky ground, and it's not just a small tremor, it feels like the early rumbles of a potential market crash. Look, history has a way of repeating itself, and the parallels between now and infamous market crashes like 1929, 1972, and 2000 are too close for comfort. The signs are there, staring us in the face. Speculative stocks, once soaring high, are taking a nosedive. Around 40% of all Nasdaq stocks are down over 50%. It's like a domino effect, and it's not looking good. Let's call a spade a spade. We might be in the midst of what I'd call a super bubble. It's not just a regular bubble, it's a supersized, turbocharged one. The characteristics are all there: a long bull market, crazy behavior in the markets, and an acceleration at the end of the bubble. It's the perfect storm for a crash. So, what's the likelihood of a market correction? Well, brace yourselves because it's plausible that the market could come crashing down by 50% from its peak. And if you're holding on to speculative stocks, they might be in for an even rougher ride. Let's break down what's fueling this potential disaster. Stimulus programs and individual investors buying the dip have been keeping the boat afloat, but the ship is still sinking. Corporations may be well funded, but that hasn't stopped the market from taking a nosedive. Why? The struggle with higher interest rates and inflation is real. Now, when we look globally, the extreme overpricing and wild behavior seem to be more of a US problem. That's why I'd suggest considering investments in countries like Australia, the UK, Japan, or emerging markets. They're not caught up in the same craziness and are considered reasonably priced. It might be time to diversify your portfolio and not put all your eggs in the US basket. Let's talk about the end of what some call the golden era, or Goldilocks. The past 20 years have seen higher PEs, profit margins, and corporate power. But the party might be over, and the hangover could be brutal. It's a new financial landscape, and we need to adapt. Inflation is throwing a wrench into the works, and the market's response is downright bizarre. It's deviating from historical patterns, and the belief in temporary inflation seems shaky at best. The Federal Reserve might try to control inflation on the down low, but with labor shortages and rising wages, it's like trying to stop a leaky dam with your finger. Now, when it comes to investments, the advice is to tread carefully. Own high-quality US stocks if you must, but non-US stocks, especially in emerging markets, seem to be the smarter move. There's a struggle ahead for the market, and FOMO, fear of missing out, should be replaced with caution. Let's talk crypto. Bitcoin has been the talk of the town, but let's face it, it's not the golden goose some claim it to be. Smarter cryptocurrencies are taking the spotlight, and the value in most cryptocurrencies today? It's a bit of a hoax, a smoke and mirrors game. When it comes to valuation, we need to get back to basics. Dividend discount models make more sense than relying on price-to-book ratios. Accounting entries can be deceiving, and we need a solid method to project earnings into the future. It's time to focus on real value. Emerging markets might be the unsung heroes in this financial drama. They're cheap, and while there are risks, the potential for attractive buying opportunities is too good to ignore. Diversification is key, and the growth potential in these markets is something to seriously consider. Let's zoom out a bit and look at the bigger picture. There's a global baby bust happening, with declining fertility rates in developed markets. It's a demographic shift that could impact economies. The US might have a slower rate of decline in the workforce compared to Europe and China, but it's not immune to the broader trends. In conclusion, folks, the warning signs are flashing, and we can't afford to ignore them. The potential for a market crash is real, and we need to be prepared. The US market's extreme overpricing is a cause for concern, and a cautious approach is the need of the hour. Look beyond borders, consider emerging markets, and don't be blinded by the FOMO. It's time to prioritize value and diversify. The financial landscape is changing, and we need to adapt before it's too late. Disclaimer: the information is for general purposes. Viewers should conduct research and consult professionals for financial decisions. Please go ahead liking, subscribing, and sharing with friends to support our channel.